Why the wealthy buy hard assets over stocks. Investor focus. Today, deep down, you likely harbor a specific question. While we diligently chase stock market charts and invest in mutual funds, why are the truly wealthy quietly and consistently accumulating an entirely different class of asset? Why does their portfolio feature old apartment buildings and gleaming gold bars more prominently than high-flying tech stocks? This video will reveal the complete answer. To start with the conclusion, what they are truly aiming for is not fleeting, high-return stock gains. What they prioritize are the three fundamentally powerful defensive capabilities of hard assets. This strategy is rooted in a philosophy less about accelerating wealth creation and more about absolutely preserving and defending it. This video will clearly demonstrate the specific strategies the wealthy employ to cleverly defend their assets from economic volatility and the insidious threat of inflation that most of us overlook. And you will gain practical, actionable insights to elevate your own portfolio to the next level. Especially if you have started feeling the limitations of relying solely on earned income and public equity markets. The three defensive capabilities of hard assets. Defense mechanism 1. The ultimate inflation hedge. The first, and most primal, reason the wealthy favor hard assets is their absolute defense against inflation, or the inflation hedge. Inflation erodes the value of money. The cash you hold in the bank and fixed income bonds see their purchasing power diminish as prices rise. Hard assets, such as real estate and gold, possess a different nature. Due to their physical existence, rising consumer prices are generally synonymous with the rising cost of acquiring physical goods. As construction costs, labor wages, and land prices increase, the value of physical real estate automatically trends upward. Unlike stocks, which are subject to market psychology, the value of hard assets is anchored by this tangible cost reality. Real estate, in particular, offers a double layer of defense against inflation. First, the appreciation of the asset itself. Second, the defense of your cash flow. Rents are inherently easier to raise in line with inflation upon lease renewals. This means that as your cost of living rises, your rental income cash flow also increases, preserving your real purchasing power. Crucially, hard assets cannot be printed like paper currency by a central bank. The wealthy understand that this is the simplest and most universal way to protect the absolute value of their wealth from the structural risks inherent in modern financial systems. Defense mechanism 2. The power of leverage and tax optimization. The second capability is the powerful combination of leverage and tax efficiency. Especially unique to income-producing real estate, a true capitalist tool. Few ordinary investors would buy stocks or mutual funds entirely on borrowed money, as it is extremely risky. However, in real estate investment, securing bank financing or leveraging capital is common practice and is considered entirely rational. With a small amount of your own capital, you can use the bank's capital to control millions of dollars worth of assets. This acceleration of capital control is one of the primary drivers of the wealthy's rapid asset growth. Furthermore, this borrowing combined with depreciation and non-cash expense becomes a powerful weapon for high-income business owners and executives. Depreciation is an accounting mechanism that allows the decrease in a building's value over its useful life to be written off as an expense. Critically, this expense does not represent actual cash leaving your pocket. A non-cash expenditure. By utilizing this mechanism, not only can profits from real estate investments be offset, but a portion of the tax burden on the high income earned from your primary job can be legally minimized. For high income earners who face high marginal tax rates, this is a supremely important strategy for optimizing taxes and maximizing the cash they retain. The wealthy consistently think about how to keep the profits as much as they think about how to make the profits. Defense mechanism 3. Control and informational asymmetry. The third and most decisive factor, which becomes increasingly important with investment experience, is control and informational asymmetry. Buying shares in a publicly traded company is essentially an act of trust, where you entrust the company's future to management. As one of many shareholders, you have virtually no say in its operation. However, when you acquire an income-producing real estate property, the situation completely changes. You can decide everything yourself, setting rents, implementing renovations, selecting tenants, and choosing management methods. This is not passive investing, it is an active business venture. Even more critical is informational asymmetry. Publicly traded stocks are subject to transparent information disclosure via exchanges and investor relations. Information is homogenized, making it difficult to find a genuine edge. In contrast, hard assets, especially prime, off-market real estate in local areas, highly unique fine art, or private equity shares are not publicly disclosed. Only the wealthy, leveraging their unique, specialized networks, can acquire this non-public information early and purchase assets at a discount. They are moving their battleground away from the fiercely competitive stock market, where everyone knows the same information, to the hard asset market, where only I know this information grants a decisive advantage. This is the core reason their returns diverge so significantly from those of the average investor. Specific hard asset portfolio strategies. So, what specific hard assets do the wealthy integrate into their portfolios? Let's look beyond the generic terms, real estate and gold, to the actual strategy. First, they prioritize cash flow generating real estate such as urban apartment buildings or commercial properties. They focus on assets, even if expensive, that are in prime locations with low vacancy risk, ensuring a sustainable stream of rental income. Their ultimate goal is not maximizing the asset's appraisal value, but maximizing free cash flow. Second, precious metals like gold and platinum. These function as the ultimate insurance against scenarios where economies destabilize, inflation spirals out of control, or geopolitical conflicts threaten fiat currency values. It is standard practice among the wealthy to allocate 5% to 10% of their total portfolio to gold as a primary hedge against catastrophic market declines. Third, collectible items such as fine wine, classic cars, rare watches, and contemporary art. These are not merely luxuries, they are unique hard assets with limited supply, which allows their value to be maintained. In the high net worth transaction market, they provide aesthetic pleasure while serving as unique hard assets, whose value tends to rise during inflationary periods. Conclusion and call to action. To summarize, the wealthy choose hard assets not merely for profit. It is because they seek defense against inflation, tax optimization, and, above all, the power to control their own destiny in the investment landscape. They refuse to be consumed by the market waves and instead relocate their fight to arenas where they can control the outcome. If you are a business professional over 30 who has begun to feel the limits of salary and public equity investing and are aiming for the next stage, your next step should be to begin researching income-producing hard assets, viewing it not as a hobby, but as a business strategy. I hope this video has fundamentally shifted your perspective on asset strategy. Thank you for watching. The path to success is often hidden in places different from where the majority treads. Please subscribe, hit the like button, and leave a comment below, so we can continue to refine future content based on your feedback. We will see you in the next video. Thank you for watching.